Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get over to Dave Peacock. He's the CEO of Advantage Solutions. He joins us live from St. Louis, Missouri, and we want to talk a little bit about retail sales and the economic data that we got in this morning. Dave, I see retail sales coming in stronger than anticipated on the headline, but if you take out cars, they're weaker. Cars and gas, they're weaker. What's your view?
Yeah, we're seeing, I'd say, a resilient consumer, but at the same time, a little bit sluggish, especially in the space where we work, which is food and personal care primarily, the retail sector. And some of that is because of the 22% higher prices for groceries that you've seen kind of coming out of the pandemic, while wages are catching up with that. I think for certain consumers, it's forced them to go value seeking.
Are we still way above pre-pandemic levels as far as things like that, the stuff that I actually use and eat?
We are. So depending on the category, but overall, groceries are around 22% higher than they were pre-pandemic.
As far as promotions, I want to set the table for Thanksgiving. Should I just stick to promotions, the things that are discounting?
You know, our proprietary research, the Advantage, says that 40% of shoppers are going to either pull back or trade down in as they shop for the holidays. So when we look at trading,
trade down from a turkey though?
Well, size, to be honest, because it's sold per pound. So you might actually see people buy a smaller turkey. You also have different price points if it's frozen or fresh. And then if you look at the other items in the store, you're seeing private label products growing in the retail sector, while national brands are flattish to declining a bit.
So rather than go with the Butterball, you look at the Kirkland turkey. Are consumers trading down still from, name brand stores? I'm not going to go to Chico's. I'm more likely to go to Costco. Is that the case with everybody else?
You're continuing to see channel shift into the value segment, into the club stores, into mass merch. And so, yeah, you are seeing that channel shift with some consumers.
Are you seeing the discounting? I mean, John mentions it. He's always on the lookout for a sale. But are producers offering discounts more than they normally would around this season?
You know, you're seeing continued discounting, but if you look at percent of volume within the grocery store more broadly sold on deal or sold on promotion, we're still actually a little bit below pandemic levels. So what consumers are doing to value seek is some are looking for promotions, but at a lower rate overall than pre-pandemic, but they are looking at private label and they are looking at different channels where prices can be lower.
If retail sales are up in this period, does that mean debt is also up? Are they putting it on credit cards? Do you measure that?
You are seeing credit card balances increase and increase somewhat dramatically. When you look at items like food and personal care, they tend to be within the normal budget on a month-to-month basis for most consumers. And so where you're seeing debt creep up potentially is things like higher value durable goods.
This is a question for both of you. Who can afford a new car these days?
Well,
I mean, it's not average.
I'll just step in.
It's not the average Joe,
John,
right?
I'll just step in, John, and say Bloomberg News did a great story last week pointing out that even the top quintile is finding it difficult to afford a new car and therefore looking at used cars. That's why, you see the retail number, retail sales advancing month over month, 0.4%. We were only looking for 0.3%. So it's doing well. Then you look at the ex-auto number and it's doing poorly. And I guess that's because the price of new cars is just so high. Is that the case, Dave?
I think that's the case. And you're looking at dollar increases. And so pricing plays a factor. So one thing that we look at, because we operate in the retail space, so grocery stores, convenience stores, mass merch. But if you look at restaurants, you saw, I think, 0.7% in the service sector growth. But pricing overall in food away from home has been growing at 3+ times the rate of food at home recently. So food at home prices have been going up around 1.5% in the last year. And food away from home and restaurants has been closer to 3.5 to 4.
But on the durable goods, do you see prices of other, big ticket items like appliances as high as they are with automobiles?
Yeah, you're seeing pretty inflated pricing. And I don't know because we don't work in the automobile space, but the question would be how much inventory are dealers holding and what kind of deals are being offered by both dealers and manufacturers to get product off these lots.
Going forward, are retailers confident that they can still pass costs along to consumers?
Yeah, I think it's to some degree, and it's really a question of manufacturers more than retailers, because retailers are often the one receiving the pricing. There are commodities, depending on what you're making, what food you're providing, what personal care item, for instance, that are still increasing or still at elevated levels. And so, cocoa and chocolate is a good example of that. And we saw that during Halloween, and it certainly suppressed some of the volume during the Halloween window. So people are going to pass it on when they have to, but I think they're more reticent given the economic realities.
What does all this mean for the holiday shopping season?
It's a short season, right? So we have a late Black Friday, we have a late Thanksgiving, and so the season will spread over 22 or so days versus 34. And I think it'll be interesting to see how supply chains hold up relative to a more compressed demand. 63% of shoppers, based on our research, indicate they're going to shop a little earlier. So we may be seeing some of that creeping in earlier in November. So it'll be interesting to see where the retail sales come out for the next month.
Hey, can you address for us the divide between the haves and have-nots and what the overall retail picture looks like right now?
When you say have and have-nots, do you mean by retailer or by consumer?
Well, we'll do both, I suppose.
Yeah. I mean, what we're seeing, let's look at the consumer, because I think everything starts there. What we see is, lower income consumers are really kind of strained in this economy, especially with the elevated grocery prices we talked about, which are a day-to-day item. And so they're the ones that are going to different channels. They may be pulling back a bit on their purchases, which is why you're seeing slower volume. And they are looking at private label products. On the upper end, one thing, at least in the food space where we operate, you are seeing for some is GLP-1 drugs. As much as 15% of a company's pharmaceutical expenses within their benefits plans can be going now to GLP-1 drugs, depending on the company. It's not saying it's everywhere, but there is belief that it is having an impact on demand, especially for that higher end consumer that can afford those medications.
Yeah, I can't afford them, but I can't wait to get my hands on some Wegovy or Ozempic.
Doesn't your healthcare plan pay for that?
They won't. They say I'm not fat enough yet, but
what about me?
I'm doing my best. John Tucker, we can both try and find it from an unregistered pharmacy.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's shift gears a little bit to politics, or at least large corporate involvement in politics. Brooke Sutherland joins us, Bloomberg's Boston bureau chief. She's also the writer of the Industrial Strength newsletter, and she has a story out on the Terminal entitled "Nobody Knows What's Going to Happen. CEOs Brace for More Trump." Brooke, it's interesting. You kick off the story talking about how corporate leaders just really didn't want the same thing that the American public wanted, and that is Donald Trump in a second term.
Yes, I mean, I think, if you look at a lot of the policies that he has proposed, they're not necessarily pro-business. Of course, you have the prospect of lower regulation, lower taxes. Those are the types of things that businesses love to hear. But you also have the possibility of a trade war and, a reignition of inflation, which is not helpful for business leaders. And then, there's also just the chaos factor, the possibility of governance by tweet returning and becoming sort of a commonplace thing. I think we all forget a little bit about what exactly it was like during Trump's first term, but he would rather frequently target specific companies who he was frustrated for whatever different reason. And that creates a lot of volatility, a lot of instability for these companies that really crave predictability and like to make their decisions on a playing field that they understand and can anticipate.
On the other hand, did you hear Jamie Dimon talking to Lisa Abramowitz yesterday?
Yeah, terrific interview.
From the APEC summit in Peru. He said bank leaders, whether they voted for Trump or Kamala Harris, were dancing in the streets. He was pretty upbeat, Brooke.
Well, I think it might depend on what industry you're in. I mean, I think banking is certainly one that expects to see a lot of relief on the regulatory front, and probably would be less likely to be directly affected by anything like tariffs. Whereas manufacturers, even those with substantial U.S. manufacturing operations, it's extremely rare for those companies to have entirely domestic supply chains. They like to talk a lot about local for local manufacturing, but what that means is North America in terms of supplying their U.S. operations. It's not necessarily just America. And so a lot of these companies rely on raw material or component imports to some extent. And all of that could potentially be vulnerable under the tariffs that Trump has proposed. Now, there is a sense that, some of this is perhaps bluster. It's a negotiating tactic that, the policies that he's put out there, whether it's 60% tariffs on China goods, up to 100% tariffs on goods from Mexico, 10 to 20% on everybody else, that these are not necessarily the final destination. It's, meant to be more sort of a negotiating tactic. And if that is the case, then, I think a lot of these companies have shown an ability to be adept and pivot their supply chains, but I think it's very unpredictable right now, and it's not entirely clear what his goals are. And he has focused a lot on Mexico. And if you look at Mexico, that really was one of the biggest beneficiaries of the tariffs from his last term, because a lot of companies who had supply chains in China decided to bring those back to North America, but they didn't put them in the U.S. They put them in Mexico, which has seen, a really big boom in spending specifically by manufacturing.
Yeah, is there really a cost-effective way for companies to bring their stuff back to the United States?
Well, to do it effectively, you have to have robots or automation. And, there are some industries for which that works better, for which it, makes more sense to invest in automation. And there are others for which it is much trickier. And, some of the companies that have been investing in Mexico are doing so in part because they really struggle to find the labor that they need in the U.S. And so, whether or not you have automation, just getting the people that you need can be very challenging. And even now, as we've seen sort of some of these labor shortages ease, you still hear manufacturers talking all the time about how difficult it is to get a quality workforce. And it's important to remember that this was a challenge for the industry even before the pandemic, which certainly exacerbated things. But this has been sort of a long-standing issue in the U.S. Factory jobs tend to be very rigid. There's no work from home. They tend to operate on like a very set schedule, and that is not appealing to a lot of the American population.
Yeah, it's, I think, a fascinating story and a fascinating topic. I just spoke with Peter Rawlinson, the CEO of Lucid, and we were asking him if he was bummed about maybe losing the tax credit or the fact that his chief rival, Elon Musk, is like best friends with Donald Trump now. And he pointed out, hey, we build and produce our products here in the United States of America, and I think Donald Trump wants to keep manufacturing here.
One of the things that CEOs and investors always want is certainty. It doesn't sound like from
that's true,
Brooke's
and that's
reporting that they're getting much of it right now.
I think Brooke's main point. Brooke, thanks so much for joining us. Definitely recommend you read the story. Nobody knows what's going to happen. CEOs brace for more Trump.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Now, we had seen shares of Tesla and Rivian sliding yesterday on a report that Trump plans to axe the $7,500 EV tax credit put in place under the Biden administration. You do see Tesla shares bouncing back a bit today. They're up 3.5% after falling 5.8% yesterday. Rivian, though, still down, and I spoke earlier this morning with the CEO of Lucid, Peter Rawlinson. His shares are off another 4% today after falling 5% yesterday and have hit an all-time low at less than $2. Lucid trading for $1.99 a share. I want to bring in Steve Mann, Bloomberg Intelligence Global Autos and Industrial Research Manager. And Steve, I guess the main question, how will the EV industry be affected by the Trump administration?
Yeah, if Trump decides to kind of remove or cut the $7,500 tax credit or EV tax credit, I think most people believe that the EV penetration will stall. If not stall, it will probably fall. Because a lot of the consumers are relying on that $7,500 to make sure, to bring down the price, the effective price of the vehicle, most EVs sold in America are still very expensive. There's only a limited number of them that are under $50,000. So the fear is, it's going to stall EV penetration. The automakers are going to have a hard time because they've already invested. They've already committed to investing a lot of money under the Inflation Reduction Act, about over $150 billion to onshore a lot of the supply chains. So it's going to cause a lot of chaos within the industry.
So they'll be under no pressure whatsoever moving forward, possibly to increase sales of EVs.
Yeah, I think the automakers are going to have to increase incentives. I think what could happen if the EV penetration rate does decrease from about 8% currently in the U.S., you're going to be left with the strongest players. And that, to me, that looks like it's Tesla, because Tesla does have the lowest cost structure amongst all the EV makers in the U.S. And if the market shrinks, the weaker ones will probably fall on the wayside.
And oddly enough, first bro, or what do we call him, first friend, Elon Musk, he's not necessarily in favor of these tax subsidies for EVs.
Yeah, I think, to him, he thinks Tesla doesn't need them. And it's partly true. If you look at the amount of cars that are leased and eligible for the 7,500. Actually, a lot of the 7,500 tax credit is actually from leased vehicles. If you look at the amount of leased vehicles that Tesla have sold in the past 12 months, it's about 20%. So they'll get impacted. But if you compare it to Rivian, Rivian has about 50% of their vehicles leased, and those and eligible for the 7,500. So it could be a bigger impact in Rivian, and that's probably why you're seeing their stock falling much more.
Yeah, there's a limit on, you don't get the tax credit if you're buying a vehicle that costs more than $80,000. And I believe there's a household income requirement as well. You have to be below a certain level. But if you lease it, you can get around at least one part of that tax credit. Isn't that right, Steve?
That's right. That's actually what I'm referring to. So when we look at the companies who's going to get impacted, we really look at, how many of those vehicles are leased. If you look at EVs in general in the U.S., the leasing penetration is actually upwards of 75, 80, 90%. So a lot of people that actually buy EVs are leasing it to get that $7,500.
What does the EV market look like right now? I mean, I know. If you read the headlines, you would think that no one has bought an EV this year. Like, the industry's in trouble because they're so unpopular, not just politically, but, since they're difficult to charge for a lot of people, it's just not an option. However, don't we still see EV sales actually growing?
Oh, we are. We are seeing EV sales growing, especially in the second half of this year, because there's been a lot of price cuts, right, over the past 18, 24 months. In the industry, and a lot of these vehicles have become more affordable, and even especially in the used EV market, those vehicles are very competitive to gasoline cars. What the industry is really facing is it's affordability, and it's getting more impacted by the fact that interest rates are high. A lot of people cannot afford expensive cars these days, and EVs are a little bit more expensive than ICE. At the moment. So what the industry was trying to do, and I think what the IRA was trying to do, was trying to onshore a lot of the production, onshore a lot of the supply chain in the U.S. in hopes of bringing costs down, so automakers can offer more affordable EVs. And that's what we were expecting. We were actually expecting the EV penetration rate to rise, especially into 2026 and 2027.
Well, Steve, I got to break in here because I feel like, Americans have shown a propensity for taking on $1,000 plus monthly payments. I don't think it's about the price, frankly.
Where do you charge it? That's my concern.
That's the big problem. I'm test driving right now a GMC Sierra EV. It is a fantastic vehicle. It's expensive, but I think a lot of people are willing to take on debt to own a car like that. The problem is there's nowhere to charge it. I park in a garage across the street in Manhattan, capital of the world, and the only option they offer is the slowest potential charge for $20 a day. So it's just not worth it.
Yeah, I think that's a very good point. Affordability is not the only hurdle. It's the charging and the range. And, depending on the use, I think a lot of people with a second vehicle may get an EV. Someone who's using it for daily commutes may get an EV. But, America is a big country, and people love to drive cars, and there are a big majority of car buyers that are probably staying away from EVs because of that.
All right, Steve, great update. We got to hang out, man. I need to talk to you a little bit more. Steve Mann there, Bloomberg Intelligence Global Autos and Industrial.
Steve, not me.
Research manager. He knows more about cars than you do. And that's what I want to rap with him about.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I know that you have plans tonight.
We were just talking about.
You're an empty nester, right? You're gonna hit the town with some Wall Street bigwigs. I, however, have little kids at home, so I don't get to go out. But I'm excited nonetheless because Iron Mike Tyson, a 58-year-old man, is preparing to knock out a 27-year-old punk on Netflix. And there's no way I'm going to miss that. Geetha Ranganathan joins us right now, Bloomberg Intelligence Analyst for U.S. Media, and she covers, of course, Netflix as well out of Princeton, New Jersey.
Wait, is he really expected to win this thing?
Mike Tyson? He's not going to lose a boxing match.
He's 58.
All right, Geetha, I don't know if you got the odds on the fight, but what is this event? I hadn't really realized it was going to be on my TV until I started reading the news this morning.
Yeah, I mean, there's just been so much buzz building up for this matchup. It's been heavily promoted, heavily hyped. And I mean, regardless of whether Mike Tyson or Jake Paul, regardless of who wins that, I mean, obviously the big winner in either case is going to be Netflix. They have over 280 million subscribers all across the world. This is by far their biggest foray into live sports. And remember, they're really trying to build a business here from scratch, that business being the advertising business. And you need eyeballs for that. And they know they will get the eyeballs with this matchup.
So how many people signed up just to see this match tonight?
So we are, we've obviously, I think everybody who wants a Netflix subscription already kind of has one. But, for those who probably don't have one, I think this is obviously going to give them that impetus to join. And we think it'll actually end up triggering a lot more subscribers to go on the advertising tier, which is one of the cheaper options out there at $7 a month. And that's actually what Netflix really wants, because at the end of the day, they want to kind of build up that viewer base so that they can sell ads against that. So we're actually projecting that, Netflix over the course of the entire quarter will actually end up adding about more than 10 million subscribers, which is a really healthy number for the fourth quarter.
I remember the conversation my brother had with my father way, way, way back when to get cable. The great thing about cable, they don't have any ads on it. How quickly that changed. Yeah. And now it's changing for streaming.
Streaming as well. Geetha, the main question, and I don't know if you're read in on this, that I have is it a real fight? Is it a setup? I mean, are these two really going to go at each other no holds barred?
It's a real fight. This is not WWE where it's staged. So it's a real fight. I mean, I know all the bets are out there. So, everybody's excited.
Yeah, I'm pumped.
This gives you some indication of just boxing in general. Can you name who is the world heavyweight champion right now?
No idea. But I also don't really know who Jake Paul is. So I'm not caught up on non-financial news. In terms of entertainment, the only thing I know is what drives money making and streaming. And Squid Game is one of those things, Geetha. I think a ton of people watched this, and my sense is you had to get to the end, and when you did, you realized what an incredibly depressing, like disappointing letdown. I never want to go through something like that again. I would pay money not to watch Squid Game again. But Netflix is going to bring out another season of this. Is it going to do well, or have we all learned our lesson?
Oh, it's going to be gangbusters. I mean, Squid Game 1 was by far the most watched series for Netflix ever. And why that's surprising is because this is a non-English series. I mean, this came out of Korea. It was made for, you have series here that are made for something like 300, 400 million. This entire series was made for something like less than 20 million when it first came out. So it just kind of showed how, hits can be generated anywhere, how content can resonate across the globe. And Netflix will obviously go all out on the second season, just kind of knowing how much of buzz and how much of anticipation has been built already, after the first season launched.
So the Korean producers this time, are they charging Netflix a premium for this programming?
I'm absolutely sure that they are.
Apparently, listen, dude, apparently the writer, and Geetha, correct me if I'm wrong, I think I read the other day or heard from Katie or Shonali, the writer lost 7 or 8 teeth because the production process was so stressful. Is that true?
I read the same thing. Yeah. I mean, it obviously they went all out. Yes, it is true. And I saw the same thing as well.
I lost like 10 teeth when they told me I had to co-host with Matt today.
Dude, I haven't lost teeth since like the 4th grade. How do you lose teeth?
I guess it's a stress thing.
And I chewed tobacco for like 30 years.
Oh,
all right, Geetha Ranganathan, thanks so much for joining us. She is a Bloomberg Intelligence Analyst on U.S. Media and Netflix. If nothing else, at least you know from listening to us on Bloomberg Radio today that there's something to watch on Netflix today. Mike Tyson versus Jake Paul, who I guess is like
You're going to watch this with your kids tonight?
Or, that's a good question. What time does this thing actually start? I have no idea, but I'm assuming it's past their bedtime. Does anybody in the control room know when the Mike Tyson? No one knows. Well, we'll figure it out, and I'll put the kids to bed no matter what.
Now on Bloomberg Intelligence, Munis in Focus.
Focus on Munis is brought to you by BAM.
BAM!
Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Be a part of building America. Invest in
BAM!
BAM! Insured bonds. Man, me and Paul one time did a show down from Build America Mutual, and it was a fantastic experience. Got to meet all the guys that were working there. Got to really immerse ourselves in the muni market, which I love to do. We'll continue that right now with Bloomberg Municipal Bond Reporter Max Adler. He joins us on Zoom out of Los Angeles. And Max, before we get to any of the specific stories on your radar right now, I want to ask about the potential to remove the tax advantage of munis. John mentioned it earlier on. How likely is that to happen?
Well, thanks for having me. It's going to be tough to follow up that fabulous ad read. But on the tax exemption, we don't think it's that likely. It's definitely something that's been floated. We have all of these potential tax cuts that the Trump administration is going to try to push through. They're going to try to extend the TCJA. And this has been floated as a possible way to make up some of the tax revenue that would be lost. But we don't think it's that likely. Trump does have a lot of finance people in his corner. Howard Lutnick and Cantor Fitzgerald, they have some muni holdings. I would not think that he'd be advising Trump to get rid of the muni tax exemption. And the federal government hasn't proven that it can make up for the infrastructure demands that municipal bonds take care of. Right now, munis fund about 75% of the infrastructure projects that are built in the U.S. So there definitely would be a problem financing a lot of those infrastructure projects if the tax exemption was done away with.
Yeah, they'd have to turn to the taxable market. I mean, how likely is that?
Yeah, I don't know if that would be particularly likely. We do think that the taxable market would expand a little bit if Trump does get his tax cuts through. that would lessen the value of the muni tax exemption to some extent, especially in bigger tax states. But yeah, no, we don't think it's particularly likely that all of the country's infrastructure needs would be met by the taxable market.
All right, so it's not likely, but this is one of the ways he could make up for lost revenue from the tax cuts. What kind of shape are the municipalities in right now? Because a few years ago they were just swimming in cash and didn't really need to issue too much debt anyway. How do they look currently?
They're showing some signs of strain, especially in bigger cities. We see a lot of different transit agencies right now are having a lot of problems that started before the COVID pandemic and was exacerbated during the pandemic. You're seeing San Francisco is having some signs of budget strain. Chicago has been talked about a lot. They're having a lot of problems funding their public schools and just with revenues in general. So a lot of cities are showing some signs of strain, especially now that some of the federal stimulus that was injected into the cities during COVID is drying up.
All right, let's talk about sports stadiums. Tropicana Field was pretty much destroyed by, Hurricane Milton. But it's munis to the rescue, or is it?
Probably not. It's actually the team that is likely to be covering the cost of this. So as part of their lease agreement with the city of St. Petersburg, they don't pay anything in rent pretty much, but they are on the hook for any maintenance costs and the cost of repairing the stadium right now. And as you said, the roof of Tropicana Field was entirely ripped off during Hurricane Milton. They have about $55 million in damages. The Rays have been contributing to this escrow account essentially over the length of their lease, which has almost been like 27 years at this point. So there is money in that account that they'll then use for the repairs. But it won't be a muni-funded repair project.
Okay, so I saw the story where the Rays, of course, they're moving to Steinbrenner Field. The Yankees are going to let them use their spring training facility, but the worry was, will everybody fit in there? And given the average fan base, they're not going to have any problems moving into a much smaller stadium.
By the way, if people have invested in that kind of paper in the past, financing stadiums and the like, how well do those investments typically do?
They typically pay off pretty well. There's like a lot of demand for that paper as well. There are a lot of like affinity buyers that want to come in and buy credits of names that they know pretty well. It happens with universities. It even happens with smaller schools. There was a private school out here in LA, the Curtis School. Their bond sold out really well, and that was mostly like affinity buyers. But stadiums in particular do get a lot of those affinity buyers. It reminds me of a recent deal that the city of Buffalo, actually Erie County, where Buffalo is located, was marketing recently. They were trying to sell Bills bonds, as they were calling them. And that deal also was pretty well subscribed. It didn't draw as much retail demand as they expected, but certainly the institutional investors stepped up.
All right, Max, thanks so much for joining us. Max Adler there, Bloomberg Municipal Bond Reporter out of Los Angeles.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.